The audience here may not have known enough about Ben Graham's origins because he graduated from Columbia in 1914, and he was so bright, he was a Phi Beta Kappa man, but he couldn't take a factory job because they didn't pay enough money, and he lost his father and had to help his family. Because he came to Wall Street, and because he had the kind of mind that looked for principles and safety, he initiated his first job was working for a member house stock exchange firm. And I remember that he cited the fact that his boss refused to let him put out an analysis of a company because it was not listed, and the bonds not being listed were not recognized. Of course, Ben was disappointed because the very bonds that we speak of now had another title then. They were called the Computing, Tabulating, and Recording Company, better known later as IBM, and they were convertible. So anybody that listened to Ben and bought the bonds and stayed with him did very well. I think we owe a great debt to Brem and his company because the pupils and the students are now going to learn why Ben's book was called the Bible of our profession, namely security analysis, Graham and Dodd. It came out in '34. It was a result of many years practical work, and also coupled with that, to everybody's surprise, that book is now published to, I think, over 1 million sold, and in its 4th or 5th edition. Some people complained that it was too good a book, and say he wrote a simplified version, a more popular version, called The Intelligent Investor, which had a very meaningful foreword by somebody you probably know better, Warren Buffett. And I urge you to look at the 2-page introduction to Graham's book to understand why Warren went to work for him and got a great many of his good ideas before he went out on his own. And to his great credit, he's still a very strong supporter of value investing. In fact, only in today's issue, in the Financial Times, which I hope you get in London, Ontario, Warren is complaining about the terrible trade deficit we have. And he's also complaining that he's got $40-odd billion in cash and can't find anything to put into it. And so he's trying to find a lower market and one more attractive to value investing. I think that there's another side to Ben that you should look into, not at this minute, but ultimately when you're in the library. When Ben wrote a second book called Storage and Stability, same publisher, McGraw-Hill, had nothing to do with security analysis. It had to do with his long-time decision that we could do better regulating business cycles without getting slammed by a depression or by the peak of an inflation. And that book, in my opinion, will be long used and recognized because his solutions are now approaching application to the European Union, which, as you know, took about 50 years to get together. But the European Union has been had a single currency, one kind of currency, a euro, and in effect, the value of that euro is dependent upon the 26 countries who are now members of the euro, and the many more who are waiting to get into it, because each of them are concerned with their own production and their own costs, and they're groping to form in Brussels the constitution which will equalize tariff rules, law rules, lack of subsidies, and all the other good things that we learned about when we studied economics. I think basically the great advantage that the fellows at Ivey have now is that it's not too big and it's not too promotional. Business schools have grown like a mushroom all over the country, and I think there's a certain inverse of Moore's law that when a company gets too big, its quality diminishes. And I think that's also true of the faculty. they've got to be good size, and that's the most effective way to sell value investing. Now, I'm very anxious to hear your questions, and so I'd like to stop and have anybody shoot them at Tom and myself and see if we know the answers or if we admit that we don't know them.
Well, thank you, Irving. And Irving purposely kept it open so that we could respond and question and answers. And some of these gentlemen here will have questions too. And while you're thinking, maybe I'll just ask Irving. Irving, a question that came up was whether value investing was an art or science. What would you say, Irving, and perhaps Tom?
My son and I don't always agree, but we both agree that it's an art in the sense that you never saw a great painter that didn't learn as a protege or some master painter. And also that how great a man might be, he can paint some bad pictures too. But it's no science, and all the kids who believe in the equations or rules that will make for perfect markets will learn better as they get older.
Prem, if it were a science, it would be replicatable. You could put certain algorithms in the machine, and you could pop out the answer, and it doesn't work that way. So it has to be an art.
Thank you. So, anyone for some questions? Please come right to the mic and ask a question. There you are.
I would just like to know, what do you see as the great potential for value investing today? What would you recommend in terms of somebody managing their portfolio today?
I think the first answer is to work in something you know something about, or trade, an industry. I'm sort of amused by people who don't realize that the Canadian markets are far better and have much more growth in them than the American markets. And that's largely due to the fact that there's a big difference in population. You're maybe 30 million or maybe 350, but we're both about the same size. But you're much richer than we are in minerals and oil and gas and timber, and you also got a pretty good copy of the American immigration policy, the way it used to be, that you welcome people from all different countries and get the benefit of their own cultural inheritance and their own drive to become successful here. What better example than take a fellow like Prem, who came from far away and went into what I thought would be a very dull industry, and manages to develop a successful company both in Canada and in the United States. And so I think the answer is you've got to begin looking at places where markets are not overpriced, and hopefully where there are 2 or 3 sleepy companies that permit plenty of room for an alert fellow to come in and do what Prem did.
I would answer by saying that one would have to be very patient. One doesn't have to necessarily have all one's portfolio invested all the time. So my belief is that one has to stay very strongly contrarian, and you don't need all your money on the crap table all the time. Sometimes the best thing is to do absolutely nothing. So if markets are high, don't invest, and be very selective and keep your standards.
Okay, next.
Yes.
Hi, Irving and Tom. Thank you for doing this for us. My question is, I'm curious, as the baby boomers move into retirement, someone has hypothesized that there will be essentially an excess of securities that will be sold to finance retirements and whatnot, and not enough demand to fill that glut that will be then on the market, thus depressing the whole economy or the whole securities market. I was wondering, A, if you could comment on that, and B, as a value investor, I guess you would think that that's probably a good thing, but I'd like to hear your comments on that.
I think that baby boomers have had the misfortune of believing what the advertisers tell them to believe in. That is to say, they buy the big mutual funds, which are so much now in the trillions, and they, of course, cannot buy small value stocks. They can't, they swamp every company. So they buy the big capitalizations of the major 500 in the Standard & Poor's or other indices. So in effect, your concern about the baby boomers tipping the market downwards, I think is kind of a good thing if it happens, because they've not been value investors, and they might make the market more attractive for people who are value investors.
And there are certain well-known value investors who over the years who talked about a shortage of equities, and the fact that there's going to be such demand for equities that stocks were going to go up because there's going to be a scarcity of them. You may know who I'm talking about.
Hi, my question is concerning technology stocks. I was wondering if you might be able to comment on your approach to valuing technology stocks, and in light of some of the recent, I guess, the resurge of that area, how it may or may not differ from Mr. Buffett's investment strategy. Thank you.
Well, we like technology stocks only after they've crashed. So we like busted tech stocks where we can buy them at close to cash per share, where they might have a lot of cash and no debt, at book value discounts. So popular tech stocks are of no interest to us, because as contrarians, our discipline doesn't really let us buy popular stocks.
Let me give an example of what we did buy, and sometimes there are exceptions, even in the value 10 commandments, if you will. There are exceptions where you can locate a company which has either no debt or very little debt, and has management which owns a good part of the company. And then on top of that, they happen to be from mainland China, or originally from Hong Kong, mainland China. And so I'm just mentioning it not to brag about it, but to show you that there exist cases of technical companies which are still attractive. This company is called Namtai, N-A-M-T-A-I. It's run by Japanese people, Chinese people, but it's located mostly in mainland now, China. Namtai is interesting because they were kicked out of communist China in '49, but the people were smart enough to come to Hong Kong and get educated in good schools, including like some business schools. And then they went back when the government got a little more reasonable. The point I'm making is that it's possible, if you can locate an area where the area is going to grow, like certainly it's true of China, and you're willing to take the reasonable risks of changes in politics and so on.
You're back, Irving. We just lost you for 2 seconds.
Yeah. I'm wondering whether there's a new question here. Somebody's getting up to the microphone now.
Tom, it's Matthew Jarvis, and nice to meet you. I have a question. If you're looking for a company to invest in, and you look for one that has perhaps management problems or affected by economic problems, would you consider an entire acquisition strategy or a gradual acquisition strategy, and how would you differentiate the two?
I think I can answer that best by telling you that there are very few investors more successful than Warren Buffett is. If you look at all the companies he's bought, he's practically never made a mistake. Now that's due to his brain and his abilities, but it's also due to his courage. Because the first time Warren and I worked together for Ben Graham, the first time that I saw him do something which I thought was foolish was when he got tricked by a crook in a scandal of salad oil, which he borrowed money on what was supposed to be salad oil, was salad oil on the top and water on the bottom. And American Express looked like it was going to go under, but Warren had the courage to hold on to it. In other words, there are times when bad news is very good for value investors if it's not permanently bad. Or, for example, take another example out of Warren. Warren bought control of a company in California in the candy business, private company called See's, S-E-E, and he paid 3 times book, which is very unnatural. But he was absolutely right, because he recognized that the company had such a good record, and it was so efficient, that once they broke out of being limited to just the California market and becoming East Coast and all over, their earnings would go up, and indeed they have.
I would say that in general, our approach involves buying a initial position in a company, getting to know it better. For us, there's never a green light that goes on and says you have to buy it, or a red light that kind of goes on and says you have to sell it. So I would say we kind of ease into a situation over time, and frequently things that we buy go down. We do more homework, and we say, gee, you know, we were right, but we were just too early. And we have the courage of our convictions, and we'll end up buying more. In fact, some of our best capital gains have come just from that principle. So just because a company's shares go down doesn't mean it's unattractive. The question is it a greater value? And so we move slowly, both on the way in and on the way out, I would say.
Yes, I think we should urge people, especially who are in business school, not to be fooled by all of the snake oil friends in Wall Street who try to tell you you can make money in a hurry, or in a year or 2 years. Most of our holdings are 3, 4, 5, 6, 7 years, sometimes longer. And that comes to a point that I think George wrote a question about when do you sell them. It's a very hard thing to answer. But I think, quickly speaking, companies are like plants. When they begin to wither because the management is no good, or the competition gets to be too bad, you can see it and you can take your profit. But most of the time, values well bought are half sold already. And so I think we don't have that problem too often. There must be more questions.
Sure, there's a gentleman just coming over.
Good morning, gentlemen. I recently read Robert Hagstrom's The Buffett Way, and in his book, he mentioned that many of the tools that Ben Graham originally used to identify attractive candidates, like price to book and price to earnings, may not be as effective today because the market is much more efficient. And he mentioned that potentially going forward, you may have to, as a value investor, you would have to consider stocks for the growth component, specifically undervalued growth. Can you comment on this, his idea on looking for undervalued growth companies?
Well, yes, I would comment by saying that hitting Yahoo Finance and looking to see what Yahoo Finance says is not the answer. You have to dig beyond situations, and you have to sometimes pick apart companies. For example, we have an interest in a company called IDT, which trades on the New York Stock Exchange. IDT is a very complicated company in multi-industries with $1 billion in cash and no debt. You need to do work in order to understand whether that company is attractive or not. We have an interest in a company called Advanced Marketing Services, which trades on the New York Stock Exchange and hasn't filed with the SEC for over a year. That can present a very interesting opportunity if one has confidence that the management is sound. Because, you know, right away, all the institutional portfolio managers can't buy it. All of the kids who bring up Yahoo Finance won't see any earnings on it because there haven't been any earnings releases. So the question is, can you dig behind, what is standard data and get a leg up by either having confidence or doing more homework or knowing something either intuitively or in some way, not inside information, that gives you a leg up on other investors. And you're absolutely right that there's a lot of information out there today. So the way Ben practiced value investing when there was little information is different than the way we have to practice it today.
just coming back to advanced marketing, the reason they haven't filed is that some employees dishonestly overstated the earnings in order to get bonuses which they're not entitled to. Now, the amount they stole was not tremendous. Might have been $10 million. Company had sales of $400 million. But as Tom says, not filing and making it sound like maybe there's terrible other bad business, which isn't at all, because the company is owned by the founders as well as ourselves. I think we have a couple of million shares.
Here's another example.
I just want to give you on advanced marketing's business relates to 3 customers take about 80% of their business. One of them is a little company called Walmart, which has a subsidiary called Sam's Club. The other is Costco, and the third is TJ. Now, I'm saying what Tom said, that even though it looks bad now, the long-term future for a company that services such good names, which I've just given you, gives you courage in saying, yes, it came down from 24, whatever it was, and it shouldn't be selling at 7, and I think that'll prove to be the case.
Or just as another example of a company that has problems in the news now, AudioVox. It has $140 million in cash and no debt. So it has about $7 in cash and no debt. Their consumer electronics business is fine and growing and profitable. They just put out a press release saying that they can't file their financials with the SEC. And then, to add insult to injury, the NASDAQ is now thinking about delisting them. Well, of course, most investors would say, don't touch it with a 10-foot pole. We're hoping that the stock would go down with these press releases. Unfortunately, it hasn't accommodated us the way we want it to. But the problem relates to nothing to do with the company at all. It has to do with one of their prior auditors not permitting them to use the audited financials that they did 3 years ago. And as far as we can see, there's nothing untoward in the audit. It has to do with various investigations that are taking place with KPMG, nothing to do with this company. So sometimes you get a situation where a company comes out with what looks like dire news, and if the shares go down, you get a very interesting buying opportunity. So far, we've owned this stock for quite a while, and if you take away the $7 in cash, you're paying about $8 for the company. We'd like it to go down, and we buy a lot more of it.
There's 5 guys lined up with questions. Give them all a chance.
Okay.
It was interesting, though. My question pertains to a theme that you both have actually spoke of and was also highlighted in Warren Buffett's letter on Friday to shareholders about not having great buying opportunities right now, by and large, in the marketplace. And my question is, where are you finding value right now, and where do you see the next kind of theme in terms of value orientation and investing in capital markets? And if you do adhere to the principles of margin of safety, in these kind of market conditions, do you relax that at all ever? And I have a follow-up as well.
The answer is we find them with smaller caps companies, particularly those where the management owns a lot of stock. Let me give you another example. It's slightly a bit of a boast. We bought this stock at about $20 or less. And people said we were foolish because one man owned 70-odd% of it, and he ran it very much for his own benefit. But we had faith that he wouldn't cheat us. The shares are now selling on the American exchange at about $1,100, and we still have them. Now, the point I'm making is that you have to do more homework and pay no attention to what you see in the newspapers about the leading companies or what the mutual funds bought, but find out where the industries, like this company, which is the reason it went up so much, is that they do something very uninteresting. They raise hogs, and the price of pork has gone up tremendously since all this trouble with mad cow. So one never knows in advance what's going to trigger it, but there's the answer I would give you. Small caps and obscure companies.
I would also say that we're not finding a general theme that we can play and we can say to you, go look at this industry. if you came to us 8 or 10 years ago, we would have said, hey, we're buying nearly all of the demutualized thrifts. We have certain standards as to which ones we're buying, and we have certain reasons why we won't buy some and the other, but they were like shooting ducks in a barrel. You could buy them at discounts from tangible book value, and generally every demutualizing thrift was one that you should look at. If you had a deposit, you were lucky. If you didn't, well, you could still buy them from the flippers, because we would buy them. They jumped 20% or 30%. We could buy them from the flippers and still get a good price. Today, there is no overall industry that I can say, go look at the demutualized savings banks, or go look at this, or go look at that. The only thing I can say is we maintain a really strict contrarian approach. So if something is very popular and everybody loves it, and we're buying it, we have to say to ourselves, what are we doing wrong here? Because I'd say half of the price of a common stock is fashion, basically. So what we're doing is we're buying long skirts at the thrift shop when mini skirts are in favor. So we're buying the long skirts for $1 or $2 and then waiting till long skirts come back into Saks. And if you can do that, you're halfway home. You know, you're almost halfway home if you can just stick to being a contrarian.
5 guys waiting.
Okay.
Yeah.
My quick follow-up is based on this contrarian approach. Is it a kind of a one-way? Is there ever any consistency in actually trying to take advantage of markets that you do feel have silly or lofty valuations?
We basically don't short stocks. We basically don't use derivatives. We really believe, as Ben did, that we're buying a little piece of a company, and that you know, we are owning a piece of a business.
I was wondering, you mentioned earlier that Canada has some great growth opportunities. Given that this country is very natural resources based, how does a value investor analyze a company whose cash flows are very dependent on fickle commodity prices?
Well, I'd give this answer. We last year did about 4 times what our cost was in an American company called Prima Energy, which is located in Denver, Colorado. Now, the reason we bought it is that they also didn't have any debt, and they also had a man who owned 20 or 30% himself, and they located a lot of new coal-based gas in 2 states, Wyoming and Utah, and a Canadian company, I forget which, did us the honor of buying the stock that we paid so little for at $39.50. Canadian producing or something like that. Look it up. So there's a way, even in an overpriced market, to find an underpriced stock. Yeah.
Hi, good afternoon. Warren Buffett's gone on record calling derivative instruments weapons of mass destruction, and instruments that are capable of wreaking havoc across global economies and so forth, evidenced by long-term capital management. What are your thoughts on derivative instruments? And I know you've gone on the record saying no, you don't use them, but what do you think about the tangible benefits?
We would agree with Warren in the sense that we don't think that any of the regulators have a completely full grasp on the danger and exposure to financial institutions from derivatives and the assumptions that are underlying maybe the liquidity of these instruments. So it's a problem, and you know, just the way dirty bombers in downtown Toronto are a problem that people think about. We don't have any particular clear answer to it, other than to say that we hedge against risk by buying good value, and then we can sleep at night because we hold these stocks. We don't worry about them. We know we're buying $1 for less than $1, and over time we're going to make money.
What do we got now? Another question.
Yeah, hi. My question relates to on the macro environment. You're seeing increasingly manufacturing moving broad, and companies increasingly focus on their service component. How does that work out in the value in terms of being able to invest in increasingly service-based companies in North America?
Well, I don't think that we really focus on macro. Basically, people who do Graham-related security analysis are interested in micro. And of course, if a company is in a business that's, let's say, manufacturing something and there's potential competition from abroad, you have to take that into account. For example, we own shares of a company called Hager, which makes men's pants. I happen to sit on the board of directors of that company. The stock sells at about 18 and a fraction and has a tangible book value in the low 20s. One of the things they did was over time they got rid of all of their factories in the U.S. and now source 100% of their products from abroad. I think maybe 15 or 20% come from factories they have in Mexico and the Dominican, but the rest come from Uzbekistan, Bangladesh, Indonesia, China, all different kinds of places. So sometimes there can be an opportunity when a company is in transition to, let's say, being from a domestic sourcer to being a sourcer from abroad. So it's an issue, and competition certainly from abroad is an issue. But our focus is micro, not macro. And, you know, every investment firm, every investment bank, every commercial bank has economists who will give you their macro opinions of things. And, you know, our view is if you take 20 of these guys' prognostications and 10 of them are right and 10 of them are wrong, why don't you flip a coin? What do you have to listen to all these brilliant words from some economist?
No incoming video.
That's all right. You can talk.
Yeah, I think that the questions, many of them are good, but they should be more specific, if possible, and talk about companies that you know something about or which you think should be studied by outside people.
Thank you both for being here today. I have a two-part question. I know you said before you can't suggest an industry, but I guess, in your opinion, internationally, what region do you think would provide opportunities to find companies that are suitable for value investing? And also, because of your length into business in the industry, how's the composition of the companies that you've looked at changed over the years? Is it tougher finding value plays in North America? That's the question. Thank you.
I think clearly it is tougher, but because there is too much money chasing very nondescript average stocks and putting high PEs on them. But just the same, companies, if you look at the Dow Jones 50 years ago, or 40 or 30 years ago, you'll find very few that persisted. The great, wonderful ones became dogs, and some of the dogs disappeared entirely. So I think you can't use the argument that it's difficult to find something. It is true. That's why diamonds and pearls are so expensive. They're not very common, but you reward the people who find them.
Well, we would agree that it's harder to find attractive situations, and there's no law that I know of that says you can't hold cash. We also have to be very cognizant of the potential risks in buying foreign securities. You have currency risks, you have legal risks, you have political risks. You understand all the risks, and the question is, you know, can you enforce a contract in Russia, or can you enforce a contract in mainland China? And you say, what do I care? The stock keeps going up. Well, you should care. So these are all concerns. And I would say in general, we're not adverse to buying international companies, but we have to put into the equation all of these risks.
Yeah. Yes. Yeah.
Thank you again. I was just wondering if you can comment on the issue of growth and how you assign value to it. I know it's a scary subject for most value investors, and they don't really like to assign too much value to that particular aspect. But Ben Graham and Warren Buffett both have said they actually prefer they don't mind paying a higher PE for something they can see sustainably growing, as opposed to something that's growing slower and they don't see too much value there. So how do you, in your firm in particular, assign value to growth?
Well, let's say we start off with the notion that you want to grow your capital. You don't care whether it's, you know, a growth company or not a growth company. You're not particularly concerned whether, you know, the earnings grow rapidly or they don't grow rapidly. You know, you want your capital to grow. So that's the first thing. Would we pay up for a company that had clearly defined great prospects? Well, you know, one of the problems is if a company has, you know, clearly defined great prospects, you guys know it already. You know, you're smart guys. You know, you're in a top business school. You know it. So then the question is, how do you determine how much of those great prospects are already in the price of the stock? How do you make a determination as to what element the price of the stock, how much of that's because people like you folks have identified the great prospects, and we don't feel particularly comfortable paying up for those great prospects because we don't have a way to figure it out. We'd rather have a company that most of you guys say is, gee, this is terrible, you know, and nobody wants to buy it, because then we can figure out, you know, what it's worth and where the shares are selling and so forth. So we want to grow our money. We at Kahn Brothers have grown our capital over the years, and I would postulate we've taken lower risks than the S&P or Dow or a lot of others in the growth of our capital. So we want to grow our money, and we don't have to grow it necessarily in growth stocks. Everyone's enamored of growth stocks. I mean, how about growing your capital from non-growth stocks? That's all right, too.
Sorry, just to follow up then. In that case, when Warren Buffett made the decision to invest in a company like Coca-Cola, in the, you know, taking Charlie Munger's advice, could you justify that kind of decision, or would you choose or try to stay away from those kind of situations?
I think Warren became a born-again Christian when he met Munger, the very successful lawyer who was his partner. And Munger persuaded him, and strangely, he yielded to the idea that he had such a wonderful stream of cash flowing from all of these insurance company premiums that Berkshire already owned. They looked for places to buy a name. And you can't argue with the idea that Coca-Cola was a big name and a good name. I think so was Gillette. I think he held on to him too long because he didn't know that ultimately Procter & Gamble was going to buy him, and he certainly didn't know that Coke was going to go through 2 or 3 vice presidents, and Pepsi was going to have better sales than Coke did. So I think you're asking a question which really doesn't have any answer unless you speak about to set a specific company at a specific time.
Well, I would also say that we can't criticize what Warren has done, for sure. But he has a different approach, obviously very successful approach, than we have, or than a Walter Schloss, who's now retired, had, or Pete Condell has. So there are many people who are disciples of Ben who follow value investing with different nuances to it. And I would say that, to answer your question, we wouldn't buy Coke and we wouldn't buy Gillette. But Warren feels comfortable with them, and obviously he's been immensely successful.
Let me tell you a funny story about Warren. Warren went to Columbia Business School, and some of the generous people endowed a chair, it wasn't a chair really, in Ben's name, Graham and Dodd, and put up the money. Unfortunately, they didn't do the good things that you've done here with Prem and George in having an ongoing professorship. This money at Columbia is just used for once-a-year breakfast, kind of a fundraising. But I remember meeting Warren there and kidding him. I asked him if he came to New York, well, on his private jet, and he said yes. I handed him an envelope, and I said, put it in your pocket and read it on the way back. So I never knew what he said. he told me later on it was the name of a Coca-Cola subsidiary of all places in Canada. It's still there. It's called the Canadian Enterprises. And as usual, the mother company in Atlanta owned 49%, and it's usually very profitable. The one in Canada, for some strange reason, had a loss. Stock went down. It was below the book. And I was teasing Warren that here was a chance to buy the same company that was buying a small infant.
On the question, sort of touching on the last question about brands, about Coca-Cola and Gillette, can you talk about one of the key things that we've learned in our course is about sustainable competitive advantage? And I was wondering, how important do you see that as a criteria in your investments? And how do you see a company, like an apparel company like Hagar, how do you see them as having a sustainable competitive advantage other than their brand, or is their brand that sustainable?
Well, it's an interesting question because what you have is in that particular instance, you have a company which has not produced the kind of returns on capital that you would expect a company to produce that's in a very competitive, difficult business. So sometimes you have a situation where a company may not be earning what it should be earning, and that may represent the business opportunity for management to get the earnings to the level where they should be. Sometimes you have a situation where a brand is owned and doesn't appear on the balance sheet, and perhaps it has some value. So in instances like that, they're very interesting. Sometimes you have patents which don't appear on a balance sheet. We own a company called Hologic, which makes X-ray machines, and they have a patented technology to digitize X-rays, which they bought from DuPont. So there can be hidden assets in terms of brands or patents or things like that, which makes some of these companies very interesting. There can be underperformance on the part of managements, which can present opportunities for improving earnings. So we tend to look at those things.
Somebody else said no.
Hi, just mentioned these days most of the really valuable resources actually come from the unpublished resources. So I want to know how can you get that, of course, except for great networking?
Are you referring to, what did you say, commodity prices or?
No, I'm sorry, I rephrased my questions. You mentioned compared with many years ago, these days it's very difficult to find value from the published resources. So you said we need to do the researches, but I'm wondering how could you get these resources?
Oh, how do we do our research? Is that your question? What resources we use?
Yes.
Well, one way to approach these things is to pick up today's paper. And you'll notice, I haven't read it, but I could swear this is true, that the new high list is extremely large and the new low list is extremely low. That may tell you certainly something about the general market environment. But believe it or not, looking through the new low list, which is pretty paltry today and there's not much you can find, doesn't seem like a high-tech, sophisticated way to do investing, but sometimes you get very interesting ideas from companies that are on the new low list. Another example, companies have a problem. The specialist firms on the New York Stock Exchange are under investigation. All these stocks tank, Vandermolen, LeBranch. All right, it's an area to be looked at. We looked at them. We elected to pass and not buy any. Insurance companies are under investigation. Marsh McLennan. Problems. We did another look. We did some calculations. There's a lot of debt and what Putnam's worth and so forth. We elected to pass. But every day in the newspaper, there are problems in a company, an industry, that create concerns on the part of investors. And I would recommend that the students read the paper, when they find there's a problem in a company or an industry, pull out the financials, do some work, see if in effect any of these stocks have gotten knocked down to where they are attractive, and then see if you can convince yourself that they are attractive investments. But that's certainly one way to look. And that has nothing to do with what you hear on TV with the talking heads. It has nothing to do with any of the programs on TV. The journalists are only interested primarily in which stocks are moving. So take the other side and look at the industries and the companies that are having problems and see if there's anything of interest in that area. That's a good way to start. Wait a second.
Mr. Irving, thank you very much for having this teleconference. I have a question. Over the past 70 years, you have so many successful investments. Which one you think is the best investment ever over all this success? And like how you spot the success and why you think this is the most successful investment you ever made?
What was your most successful investment and how you spotted it all the way over the years?
I think the answer is that I once went to Japan, and there's a company in Japan called the Mikamoto Company that's in one business. They fish oysters and look for pearls in the oysters. And if you ever go there, you'll find they employ a lot of women who have great big busts because they have wonderful lungs, and they can hold the air for maybe 3 minutes while they dive down below and place a piece of sand in between the clamshell so that sooner or later they can create pearls. Well, there's an example of a very obscure kind of business you wouldn't run into every day. And Mikamoto has a fancy place on Fifth Avenue, and they sell pearls all over the world.
I would answer, Irving went to Japan with the New York Society of Security Analysts, Financial Analysts Federation, in the early 60s. And that trip produced a lot of good results, because at that time, Japanese stocks were very, very cheap. And you could buy, Tokyo Fire and Marine for nothing, and
50 cents.
Based on its portfolio. And there were a lot of very interesting. You could buy Komatsu instead of a Caterpillar tractor, and there were lots of interesting things you could buy that really were values at that time. And probably that trip, and I may be speaking out of turn, represented the most successful opportunity.
Well, one of them.
Okay.
The most successful thing I ever did in my life was to meet Ben Graham, who was kind of a man who not only was a wonderful teacher, but he also did things like this. When I worked there one day, I saw a newspaper ad of a bond issue, and the word on the bottom was tranche, and I didn't know what it meant. So I said, Ben, what does tranche mean? He says, I know, but I won't tell you. He said, if I tell you, you'll forget it by tonight. But if you go over to the unabridged dictionary and look at the origin, you'll remember it the rest of your life. And he was quite right. And all it meant was a slice, as you know, a tranche, a piece of the bond issue. So I think a great deal of this depends upon working for a master and learning some of his logic, and the mistakes that you make, you get corrected. I mean, it's a good thing that you could have books to read, but the real thing behind the book is who wrote the book and what was his own experience in life. That's why I urge you to look at the second book he wrote, called Storage and Stability. And all you have to do is go to the web. It says bufferstock.org. And I used to kid people and say, I like to get Warren Buffett to let me change the spelling and call it Buffett stock, and I'd probably get a couple of thousand hits. And yet the idea behind Buffett stock, which is Ben's economic plan, is much more important over the years.
I would also just add that, you don't need a lot of big winners. Ben made most of his money in Geico, and if you study the history of what he did, and if you can identify just a few very cheap companies and identify them very early with really good managements
Stay with them.
and a sound thesis, if you will, and have the courage to stay with them. And when they get knocked down, buy more of them. Then over a period of time, you can do extremely well. For example, we own a company called New York Community Bank Corp., which is the old Queens County Savings Bank. That stock has ranged from $1 to $35 over the 10 years since it's been public. It's now about 19, having really gotten shellacked down from 35. Well, we still have a tremendous amount of confidence in their multifamily business model, multifamily loans, and their management. And though we have a very large position in it, we continue to buy it. It has a nice yield. We know a lot about the management. We know about their underwriting record and their conservatism with respect to their loans. For example, they just made a large loan on a large apartment complex in the Bronx called Co-op City. And I believe their loan-to-value ratio is something like 34%. So if you buy a house in, a suburb of Toronto, the bank will loan you 75%. So New York Community Bank, even though it's come down a lot, and even though we own it in fairly substantial quantities for us, we deem it to be a very attractive stock. So we have the courage of sticking with managements and businesses that we like. And I would recommend to you that you don't need a lot of really big winners in your career to do extremely well and be very wealthy.
So two last questions, maybe if there's any more. But Irving, you've lived through the stock market crash of 1929 and the Depression, and you've had a wonderful career over 75 years. Any chance of that repeating, Irving?
Yeah, you want to hear? Prem, do you want me to talk about that last point?
I was just wondering if you thought there was a chance of the 1929 crash and the depression that followed, if there was a chance that that would repeat again in the next,
I think not, for the following reasons. That crash took place in two steps. There was a real estate boom, there was a radio boom, and a merger movement of utilities, all with borrowed money. And it didn't take more than a year to pierce the bubble of 29. But unfortunately, it came at a bad time for the world. And when England left the gold standard in September of 31, then you had all the terrible things that followed. That's why you should look carefully at what Ben Graham wrote about having a single currency that's convertible into the basic commodities, because that would not happen and will not happen. In my view, the European Union is going to turn out to be a very good thing, because it's going to make all the people who are fighting with each other behave, because what one takes, the other doesn't want to lose, you see. And that concept of a closer world is what's behind that great fellow, the Englishman that created the internet and wouldn't take a dime for it. He wants to see the world united and open exchange, and that's what's going to happen. So I think, Prem, that in the case of 29, you had a tipsy market, which bad bank loans, and I can't explain why the Federal Reserve Bank was not better able to shorten the period between 1930 and 37, but the whole world was in a terrible deflation. But I don't think it's going to happen again.
I'm just wondering if there's any room in a value investor's portfolio for income trusts.
It's an income trust?
Yeah, specifically, what are you referring to by income trusts?
Well, basically, what we've seen is an explosion in the Canadian market, especially the last few years. And I just don't know how much research has gone into this from a value investor's perspective.
Well, if you're talking about trusts that buy
money fund,
buy what, REITs, bonds, what are you referring to?
REITs or royalty.
Okay, take REITs for
trusts.
example. We don't like REITs, and generally we don't buy REITs. REITs sell on a yield basis, and we believe interest rates are low and going to go up. So why would you buy a security which essentially sells on a yield basis if interest rates are going to go up. To properly analyze a REIT, you have to be thoroughly familiar with the markets in which its properties are located. Theoretically, you should be familiar with the leases that it has within those markets. And it's a complicated analysis that I would say we don't feel comfortable with. Maybe you could accuse us of being too lazy, but we have never been fans of REITs.
You talk about some factors influencing your decision while choosing the company. I would like you to summarize, please, what are the 5 most important factors in the order of priority, qualitative or quantitative, that you pay attention while finding an undervalued company? Thank you.
The first thing I would say is it should either be obscure or out of favor. So it could be a big company which is not obscure, but is very much out of favor. That's the first thing. Second thing is we're very much balance sheet oriented. So we are not interested in companies that have excessively levered balance sheets. Just doesn't make us comfortable. We like companies that have no debt or low debt. Third is we like management to be on the same page that we're on. So if there's any way that management can own a lot of stock, that's terrific.
Except
if management can be somehow incented the way we're incented, that's a very important factor for us. One of the things that we'd also like is for a company to have some leg up. I'd say one of our biggest mistakes is we have bought some commodity companies that were levered with poor management, and that's the kiss of death. You buy a company that's in a commodity business that has too much leverage on the balance sheet and has management which is not too swift. So I would say certainly avoid those at all costs. But we're not focused so much initially on the income statement. What we would say is, what is the earning potential of this business? If it were run properly, if the management succeeded in their plan to close the losing division, to do this, to do that, what could this company earn? What's a reasonable margin? What's a reasonable earnings level? And then say, is this stock cheap based on that? And what is our confidence that management can achieve that? So we don't care if a company has earnings or doesn't have earnings. In fact, we would prefer companies to be losing money, not hemorrhaging cash, because that really knocks the stock down and you get some wonderful opportunities.
It was just a question on copyrights, patents. How do you go valuing copyrights and patents? And as well, you talk a lot about management. How do you assign some sort of value to management as well? Do you look at the proven track record of management or what they can do in the future?
Well, I would say that as far as patents go and copyrights, we don't put a dollar value on these things. We have to figure out, I mentioned this X-ray company with this patented technology. We have to figure out what's the potential of this technology, whether they'll be able to, succeed in developing it or not. And I wouldn't put any tremendous value on it. As far as management goes, we're very old-fashioned. We like to sort of look them in the eye, meet them, talk to them, try to judge their credibility. One of the ways that we can get a leg up, I would say, on people who don't know anything and are just looking at numbers or looking at Yahoo Finance or watching TV or whatever, is to meet managements and try to make some assessment as to their competence, credibility, and things of that nature. And we don't seem to have any trouble, generally speaking, in getting a shot at talking to managements on a one-on-one basis. And it's an important thing. A lot of people don't want to do it, but we think we like to eyeball these people and make an assessment.
Final question. All of them here are very interested in job opportunities. If they take this course, what are the job opportunities that you see, Irving?
I think my impression is that Ivey has got a good faculty and that you tend to judge the companies not the way that I studied it one summer. I went to the Harvard Business School, and I became very unhappy because most of the cases were theoretical or synthetic ones. They were just constructed to make the point of their form. And I see that you tend to look at companies in Canada and in the U.S., and I think that was one of Ben's great achievements, that he brought people up from Wall Street after the market closed in those days at 3 o'clock up to Columbia, and they discussed what happened to stocks at that particular day. Not that he was short-ranged, but that was mostly to point out what terrible, silly nonsense was going on in the boom years, and later on to point out that as cheap as the market was, big firms like Goldman Sachs either were going out of business or moved to cheaper quarters. People forget that. And yet it was a depression that made a great many people rich because they saved their capital and put it in at a time when they couldn't really lose money in the low 1930s.
Prem, what I would suggest to your students, without demeaning an Ivy education, that once they get their degree, they're not fully educated, and that I would recommend to them one of two paths. One is to find Picasso and clean his paintbrushes. So find who is the super-duper practitioner of the approach that you want and clean his paintbrushes or get his coffee or whatever. The other would be to work for a large institution where they're relatively benign and they will let you learn and grow. And what I mean by that is, don't work for someone who counts your cash register receipts every day, because you go work for an outfit like that and all they want to know is, how much did he make for us today? But if you go work for a big bank or someone who views you as a intellectual resource and lets you grow personally and so forth, that's a much better place than going to work for some hotshot brokerage firm that wants to know after 6 months how much you made for them.
And thank you, Irving. Our time is up. We just wanted to take a minute. Why don't we show our appreciation to Irving Kahn and Tom Kahn? Thank you very much.
I'd just like to take a few minutes to express what a pleasure and what an honor it is to have the opportunity to thank Mr. Kahn for his words of wisdom. Our students have had the occasion to hear from someone who's had experience of more than 75 years on Wall Street. If that's not starting to work with the paintbrush of Picasso, I don't know what is. So I really appreciate you doing this. I think some investment professionals might have the opportunity to see maybe 2 or 3 cycles in the market. Mr. Kahn has seen the Great Depression of 1929. He's actually forecasted that we won't have another one. Certainly learned directly from Ben Graham and has seen the multitude of economic cycles that we've had since then. What richer learning environment could we all have than this? Mr. Kahn, we appreciate your candor in sharing your thoughts, your experiences, and your beliefs with our students. Most of all, thank you for helping us launch Ivey's Value Investing course. Prem Watsa has been a strong supporter of the Ivey Business School for years. In addition to being an alumnus, who we can all be very proud of, he had the vision, he had the courage, and he had the belief to work with Ivey to create this value investing course. We're also pleased to have George A. Much easier. Here at Ivey. George has worked very hard on developing this course for all of you, but it's only been successful thanks to the support from Prem, from Roger Lace, and from Mr. Kahn. This is the first course taught in Canada specifically aimed at value investing, but it's our dream to make it much larger than Canada. It's our dream to make this one of the leading centers in the world that researches, that teaches, that disseminates information about value investing and makes more disciples to follow in these very strong footsteps that you've laid before us. So to Prem, to Roger, and all the Fairfax and Hamlin Watts of friends we have here today, thank you for having the faith to work for us here at Ivey. We also have a number of friends from the value investing community here today, and we look forward to working with all of you as well to make this the richest experience that we possibly can for our students and for the value investing community. We hope this is the start of a very strong relationship and one that will endure for many, many, many years. So with that, I thank you very much. I'm sorry that you can't join us in person, but we do have a reception and a little bit of food and water, I think, at the back. So please do join, and I'm sure that all of us here are open to answer any questions that you have. It's a chance in a lifetime. So thank you again.